Hello and welcome, and we're back on set with Peter McGuire, the XM.com CEO. Pete, what's been happening the week that was? Talk to me about the week that will be.
Well, good morning, Will. We've seen a fair bit of movement. If you're looking at some of the commodities, very much bid up. Equities, we had Monday this week was President's Day, so that was a US market shutdown. But of course, the UK market was very strong. We've had fairly good movement over Monday and Tuesday. Let's see how today goes as far as Asia. We've still got the Lunar New Year holiday season in China, and so there's no movement there. And the storyline coming from the Fed, we've got a slew of data coming out this week, so let's see the big picture, how it moves forward.
Well, big picture, everybody's piling back into stocks. What's driving this stock mania? We've seen quite a bit of action. We've seen the short sellers come out in droves. We've seen social media pick up those stories and run them around the globe, really changing the way that that people can read the signal, and perhaps causing some sense of concern to the everyday punter. I mean, what's the XM view?
Well, the momentum hasn't really abated since we've seen that big turnaround from the apocalypse that we experienced in March. So really, since the April, it's just been onward and upward. How much further is there? Well, money's really, if you're looking at inflation and you're looking at what bond rates are, everyone's in a negative game. So the only saviour really is the equity market. Commodity markets are too shallow. There's not enough liquidity to really do anything dramatic with them. So equity markets is where all the fun is, and it's been a retail investor's delight, from 18-year-olds enjoying leverage with options to trading platforms and everything in between. So it's been very much a concerted effort. See, when you buy an option and you've got a market maker on the other side, this is the retail investor, the market maker on the other side has to hedge their position. And really the only way to hedge their position is to buy physical stock. So that in turn creates a dilemma for the short sellers who say, well, hang on a second, I'm going to get squeezed here. Why do I need to, the market's going up. I thought it was going down. So all of this is a loop that just keeps on feeding on itself. And we're very mindful that, many Fed bank, well, you're looking at Jerome Powell and you're looking at central bankers across the world are all saying, we're at very toppy markets, but we'll discuss that a little bit further. But maybe we've got a long way to go for equity prices.
Well, let's hold there. Let's take a look at this chart on screen. Legendary comeback for global stocks as their headlines. Past year rebased to 100. Yep. We're looking at a number of different things here. The Nasdaq Composite, the Dow Jones, and the Nikkei 225, along with the S&P 500, DAX 30, and the Euro Stoxx 50. Yeah. Pete, the dotted line indicates the Pfizer vaccine hitting the market, around November last year, or is that? It's actually November this year.
No,
last year. I stand corrected. Mate, talk me through it. We're sort of seeing. Well, what are we really seeing there?
Well, we're seeing.
It looks like a series of correlated markets responding well to the vaccine story.
Well, yeah, the vaccine is certainly one side of it, but there's just been that concerted move to the upside. We saw October being a little bit soft, fairly heavy sell-off, and then the markets revitalised themselves from really the start of November, and it's been one-way traffic since. So that, as we highlighted before, if you're looking at Pfizer and the big pharma stocks, the vaccine providers, they've been one-way traffic, and that's been very strongly bid up. But the rest of the markets have also gone in tandem, and that's been demonstrated by that chart. So it seems to be, I think, a little bit further upside yet.
Righto, mate. Well, look, moving forward with the fiscal discipline here seems to be gone. Retail traders seem to be weaponising options. In this chart, we're looking, the question really that's being posed is a risk-free asset or a return-free risk?
I think it's got to be a return-free risk. And there's the issue. Bonds they're just negative. So no one wants that side of it. Certainly the retail and the super, as far as any retirees or anyone playing the market. So the only salvation, as we highlighted earlier, is equity markets, and that's been demonstrated. Cheap money and all asset prices, well, the majority. If you're looking at Australian real estate, if you're looking at equity markets, everything's been bid up, and maybe there's more momentum there, and certainly 21 and 22 could be very good years for it, Will.
Bid up and keeping on going strong, and the question then becomes for how long?
No one's got a crystal ball. We haven't got a towel over our head and we're looking into a crystal ball and saying, right, that's the drop date.
Okay.
So that doesn't exist and that will never exist, and that's why the beauty of the markets are that you must do your fundamental research, your technical analysis, and of course your seasonality if you're a trader, and more importantly, be aware of your risk tolerance. And that's the beauty of trading. And there is no time better than getting engaged now. We run 28 hours a day of live TV for information to our membership, our client base, I should say, not members, clients across the world. We've nearly got 5 million that every corner of the globe that are trading, and that really is the depth of the market that allows that transference as far as information and knowledge.
Knowledge, signal, transactional behaviour, and then come back to that whole point. It's all about understanding your own risk tolerance.
Yeah.
But to that point, realistically, let's just chat about this chart just for one more moment. Now, there's a comment here that suggests that 20% of all trading volume last year was small investors. The combination of low fee entry points from brokerage, a little bit of spare saving, maybe boredom sitting at home on the couch. I mean, they're all drivers of an activity, but perhaps that suggests that they really need to be diving in and actually taking a bit of an advantage of some of those resources available to them to frame up that activity and
get educated. I think
educated.
it's been a wonderful time to take on board knowledge, and we've discussed that very much last year together as far as new frontiers. The chance to sit there on a couch and not have to travel 9 hours a week for transport to go to work. You're now sitting at home and you've got that 9 hours to allocate to other things productive. So if you're working from home, go and get engaged. Go and find out what the things that you want that are your touch points. Mm. And I think that's the beauty that the young really have. And life is very much along that framework, that it's a lifetime of learning. And I'm still learning at my young age of 30. Will, you're a bit older than me, but that's...
Look, it's the makeup, mate.
Well, you put it on well today, I've got to say.
Thank you very much. Now, listen, let's move forward. A very well-known name around the markets here is Buffett, Mr.
Yep.
Warren Buffett. Been there for a long time, done some interesting things. On screen is the Warren Buffett indicator, and it's flashing red, Pete. Up on the right there are a few question marks.
Yes.
Slightly left and further left, you've got the housing bubble and the .com bubble, as we go back a few years.
Certainly.
Brief me on this. What's this chart really indicating?
Well, you can see if you go all the way to the left, and you can see that 87 bubble that really, and then it capitulated that Black Monday of October 18 or 20 or whatever it was of 1987, and it just capitulated in that really massive sell-off. And then it was like bubbled along, and then all of a sudden it hit 90s, and it started to move, and then from really about 93, 94, it was one-way traffic up to the 2000 bubble. Collapsed again. Then we hit up to the 2008 housing bubble, the GFC, of course, and then all of a sudden it was like a sell-off like no tomorrow, and very, very violent. And then we've had a climb from those lows with stimulus that there's been no lack of, concerted across the world, and you're now running at a 10-year peak, and those question marks. And Will, I don't know, with negative interest rates, and that's the forecast moving forward for many years from central bankers, this could be a low point. You might be sitting there, Will, in 2 years' time going, Pete, it didn't have a reversal.
Well, Pete, it didn't have a reversal perhaps, and maybe it will. But I guess what are we really saying here? Are we saying that valuation measures are out of control? Are we saying that
yes.
The PE on this, well, actually the producers are just putting through a note now, Pete, that they're saying that the trailing price to earnings ratios of the S&P 500 is now at levels previously associated with bubbles.
Yes.
Again, indicated on that particular chart. Perhaps that's really what we're talking about.
Well, it is, but the other thing is that you're not buying money at 6 or 7% or 8% or 9%.
That's true. We're down at 0.001.
Yeah, exactly. And then you're looking at the inflation curve and you're saying, well, righto, it's cheap money. So your price to earnings becomes magnified. And there's the other side of it. So I think these are uncharted waters. Everything is just, you've got so many more investors. You've got so much more activity. I'm just sitting here going, it's a great time to be in the market in some capacity or form across some asset class.
And look, I think in this chart here, which was, really demonstrates what we were just talking about in terms of price to earnings ratios and the explosion of them. The comment here is that Alan Greenspan says that irrational exuberance for the first time is one of the key drivers.
Well, that's right, and he saw that, and that's where he mentioned that in around about that 97 period, and the markets doubled from there. So that gives us an indication how much further, and you're looking at that real inflation-adjusted PE ratio. So, yeah, it's onward and upward. Markets are saying inflation is coming. Well, inflation, I think, what demonstrates inflation to me is the cost of things. And if energy prices stay at $60 a barrel, all of those inputs are going to be affecting everything we do in life. So it doesn't matter if you're driving in an Uber, it doesn't matter if you're getting a loaf of bread or doing some form of transport, everything comes down to it's more expensive, and that's an inflationary cost. So
pretty straightforward summary there, mate.
Yeah.
It's more expensive, and that's the inflationary cost.
It costs more, but your wages don't go up, and it costs more next year, and these are all of the issues, and it's just a very... That's what I term as a layman's appreciation. You can talk about inflation for 2 weeks and not draw a breath, but a simple cost that I see is the energy costs attributable to the end item.
All right, mate. Well, let's wrap up here. We've got a quick scan of the broad indices. You've got the daily performance of the New Zealand there against the USD. That's sort of really going pretty well. New Zealand currency has been going well since this latest lockdown kicked through, didn't it?
Yeah.
And we saw a big jump.
Yes, exactly.
And then you drop to the bottom there, and you look at the dollar index, and it's kind of racing the other way. I mean, What does that tell you briefly?
Well, that US dollar is continuing to soften. We're down around about that 90.3, 90.4. That's the first market I always look at every morning I wake up. I just see how it's performing, and that gives me a trend as far as the day, whether the US dollar is being sold off. The markets run 24 hours a day, and no matter where people are watching this interview today, it doesn't matter because it's broadcast across the world on our website. Could be Brazil, could be London, could be Africa, could be anywhere in Asia. It doesn't really matter because it depends on what markets you trade. And many Asian trading markets, we're in that Asia-Pac zone in Australia, we may be Asia-centric, and we may trade a little bit coming into the Euro session and then go to bed at night for US. But the markets don't stop, and depends on where you are domiciled will dictate what market you trend and what market you trade. But that US dollar index is the big kahuna.
Righto, Pete. Well, let's wrap it there for today. Thanks for joining me. Thanks for discussing, and thanks for briefing the market.
God bless you, Will. Thank you. See you soon. Cheers.